Here is a number that should grab every trader's attention this Monday morning. The US dollar has spent 2026 slipping from its multi-year peak, yet it still refuses to break. As we open the week of the 15th of June, the world's most traded currency is caught in a genuine tug-of-war. On one side, sticky inflation and a hawkish Federal Reserve under Kevin Warsh are keeping yields elevated and the dollar firm. On the other, softer growth signals and the fading dollar strength trade are quietly pulling it lower. The result is a tense, range-bound market where one data surprise could decide the next big move. In the next few minutes I'll walk you through exactly where the euro, pound, and yen stand right now, the events that will move them this week, and my read on where the major pairs could head next. This is your 15th of June Forex briefing, so let's get straight into it. To trade this week well, you need the wider story. Through late 2025, analysts increasingly describe 2026 as a post-peak dollar world. The idea is simple: after years of dollar dominance, the easy gains are behind us, and from here the greenback is expected to drift gradually weaker rather than collapse. But that drift has stalled. Growing expectations that the Fed will keep policy tight to contain inflation have steadied the dollar and even pulled it firmer in recent sessions. So we are not in a clean downtrend, we are in a consolidation, where direction is dictated almost entirely by interest rate expectations. For you as a viewer, the takeaway is that this is a market rewarding patience over conviction. Chasing breakouts has been punished. Trading the ranges, and respecting the levels, has been the smarter play so far this June. Let's start with the most heavily traded pair on the planet, euro to US dollar. The euro has softened alongside the broader dollar rally and is hovering in the mid-1.15s, toward the softer end of its recent range. But here's the crucial nuance: the European Central Bank backdrop has turned more hawkish as inflation reaccelerates across the Eurozone. The ECB's decision on the 11th of June was the dominant near-term driver, and renewed rate hike risk is helping to limit how far the euro can fall. The base case from several desks puts euro to US dollar in a 1.16 to 1.18 band over the coming 3 months. My read for this week: as long as 1.15 holds as support, dips remain buying opportunities for range traders, but a confirmed break below it would open the door to a deeper slide and signal the dollar bulls have regained control. Now to the pound, and a pair that British viewers watch closely: pound sterling to US dollar. Cable has clawed back to around the 1.33 to 1.34 region, but the broader prospects for sterling remain cautious. The analyst base case puts the pair in a wide 1.33 to 1.38 corridor, with the swing factors being U.S. jobs data and the continued handover to the Warsh-led Fed. Domestically, the pound's fate hangs on whether UK inflation cools enough to let the Bank of England ease without spooking markets about growth. For now, sterling is essentially a dollar story dressed in British clothing. Watch 1.33 as your line in the sand, hold it and the recovery stays intact toward 1.36, lose it convincingly and the negative bias reasserts itself. I'd treat rallies near 1.36 with caution until the data clearly turns in sterling's favor. The yen is arguably 2026's most interesting trade. For years the carry trade crushed the Japanese currency, but the picture is shifting. The fundamental driver now is the narrowing interest rate differential between US and Japanese government bonds. The Bank of Japan is proceeding with measured rate increases, while the market expects the Fed to eventually deliver 1 to 2 cuts later in the cycle. That combination is structurally yen supportive, and several forecasters see US dollar to Japanese yen grinding lower toward the 139 area over the year as that gap closes. In the very near term, however, strong US inflation prints and a patient Fed have kept the pair elevated. So expect a battle: short-term dollar strength against a longer-term yen recovery. If you trade this pair, respect that tension and keep a close eye on any Bank of Japan commentary, which can move the yen violently. So what actually moves these pairs over the coming days? Mark your calendar. The single biggest event is the Federal Reserve meeting in mid-June, with the Warsh-led Fed now firmly in focus. Every word of the statement and press conference will be dissected for clues on the path of rates. Around it, Watch U.S. jobs and inflation releases, which have repeatedly been the swing factor for the dollar this year. Beyond the headline data, keep oil prices on your radar, because energy costs feed directly into inflation expectations, alongside geopolitical risk and the broader tone of global risk sentiment. Any one of these can flip a quiet, range-bound session into a sharp directional move. The lesson for this week is straightforward: position lightly into the Fed, and let the market show its hand before committing to a strong view. Now to what you came for, predictions, with the honest caveat that these are scenarios, not guarantees. My base case is a firm but range-bound dollar into the Fed meeting. For Euro to US dollar, I expect the 1.15 to 1.18 range to hold, with a hawkish ECB cushioning the downside. For pound sterling to US dollar, I see 1.33 as critical support and 1.36 as resistance, with sterling drifting sideways until UK data gives a clear steer. For US dollar to Japanese yen, the near-term bias stays firm, but I'd be alert for sharp yen rallies on any dovish Fed signal or hawkish Bank of Japan surprise. The wild card is the Fed itself. A clearly dovish steer would weaken the dollar across the board and reignite the euro and pound, while a hawkish hold would extend dollar strength. Trade the reaction, not the prediction. Let's bring it together. This is a consolidation market, not a trending one, so discipline beats bravado. Respect the key levels we covered: 1.15 on euro to US dollar, 1.33 on pound sterling to US dollar, and any Bank of Japan signals on US dollar to Japanese yen. Treat the mid-June Fed meeting as the pivot around which the whole week turns, and remember that in 2026's post-peak dollar story, direction is being decided by rate expectations more than anything else. The single most valuable habit you can build is waiting for confirmation rather than predicting the turn. Manage your risk, size your positions sensibly, and never bet the account on a single data release. That is your 15th of June Forex briefing. Keep these levels handy, watch the Fed closely, and trade the market that's actually in front of you, not the one you wish you had.